Most people think making money in stocks is about luck. They think you need insider tips, secret signals, or perfect timing. But if that were true, the same people wouldn't keep winning decade after decade. William O'Neill starts this book with a powerful idea. Every great stock winner follows the same basic system. Think about it. Apple, Amazon, Tesla, Nvidia. Before they became household names, they all looked risky. They were expensive. They were volatile. And most people said, it's too late. But the investors who understood the system didn't ask, is this stock cheap? They asked, is this company growing faster than everyone else? That's the first big secret. The stock market doesn't reward opinions. It rewards growth. O'Neill studied more than 100 years of stock market winners. Not guesses, not theories, actual data. And he found something shocking. The biggest winners were almost never low P/E, slow growth companies. They were companies with explosive earnings, strong sales, and powerful demand from big investors. Here's a real-world example. Imagine two companies. Company A is cheap, boring, and barely growing. Company B looks expensive, but profits are doubling, and institutions are piling in. Most beginners buy Company A because it feels safe. Professionals buy Company B because the market rewards strength, not comfort. And this leads to another uncomfortable truth. You don't make real money by being right. You make money by being disciplined. O'Neill emphasizes that successful investors don't rely on gut feelings. They follow rules. They know exactly when to buy, when to sell, and when to stay out. No hope. No revenge trading. No, I'll just wait and see. That's why he says stock investing isn't about intelligence. It's about having a repeatable system and sticking to it. So what's the takeaway from Chapter 1? Stop chasing tips. Stop listening to noise. And stop thinking the market owes you anything. Instead, focus on building a simple, rule-based approach. Strong earnings, strong demand, strong market conditions. Because in the stock market, the biggest gains don't come from guessing right once. They come from doing the same right thing over and over again. And that's exactly what this book is going to teach you. A stock chart is basically a lie detector for Wall Street. Companies can issue press releases. Analysts can change ratings. Financial media can hype a story. But the chart shows you what money is actually doing. William O'Neill makes this clear in Chapter 2. Price and volume never lie. Most beginners ignore charts because they think technical analysis is complicated or to trader-like. But here's the truth. Charts are not about predicting the future. They're about understanding behavior. When a stock goes up on heavy volume, that means large institutions are buying. Pension funds, mutual funds, hedge funds, the players with billions of dollars who cannot hide their footprints. And when a stock falls on heavy volume, that's distribution. Big money is leaving, quietly, before the headlines change. Let me give you a simple example. Imagine a stock reports great earnings. The news sounds amazing. Everyone on social media is excited. But the next day, the stock barely moves, or worse, it drops. That's a red flag. It means the market already expected good news, and the big buyers aren't impressed. If institutions aren't buying, the stock won't trend higher for long. This is why O'Neill teaches investors to focus on bases and breakouts. A proper base shows that a stock has cooled off, shaken out weak holders, and built support. A breakout above that base, on strong volume, signals that demand is finally overwhelming supply. That's not magic. That's market psychology. Weak hands sell early. Strong hands wait, then buy aggressively. And charts help you see that process in real time. Another key idea here. Bad stocks look bad on charts long before the fundamentals collapse. Long, slow declines. Failed breakouts. Heavy selling days. The chart warns you before the damage is obvious. So what's the real lesson of Chapter 2? Stop asking, what do I think about this stock? And start asking, what is the market telling me? You don't need to predict. You need to observe. If price is rising and volume confirms it, the stock is under accumulation. If price is falling and volume spikes, step aside. Because in the end, charts don't measure opinions. They measure money in motion. And if you want to make serious money in stocks, you have to learn how to read where the big money is going before everyone else notices. If a stock is going to make a big move, The earnings will show it first. That's the core message of Chapter 3. William O'Neill doesn't sugarcoat this. No earnings growth, no major stock gains. Many investors fall in love with stories. Cool products, big visions, exciting futures. But the market doesn't pay you for hope. It pays you for results. And the fastest way to spot real results is current quarterly earnings. O'Neill found that before almost every massive stock winner took off, its earnings per share were growing at least 25% to 50%, often much more, and accelerating. Not flat, not slowly improving, accelerating. Here's why that matters. When earnings suddenly surge, it catches institutions off guard. Analysts rush to update forecasts. Funds that were underweight the stock scramble to build positions. That's when demand overwhelms supply and prices explode higher. Think about Nvidia. Before its biggest runs, earnings growth wasn't just strong. It was unexpectedly strong. Quarter after quarter, numbers came in better than Wall Street expected. And the stock didn't drift up. It launched. Now compare that to companies with potential. They promise profits next year, or the year after that, or once conditions improve. The market has heard that story 1,000 times. O'Neill's rule is simple. Buy what's working now, not what might work someday. Another critical detail here is sales growth. Earnings can be manipulated. Sales are much harder to fake. That's why the best setups often show strong sales growth alongside earnings growth. It confirms that demand is real, not accounting noise. But there's a mistake beginners make. They look at earnings once and stop there. Professionals track earnings trends. Is growth accelerating? Are margins expanding? Is the latest quarter better than the one before it? Because the market doesn't move on good numbers. It moves on changing expectations. So what's the takeaway from Chapter 3? Ignore companies that almost make money. Ignore turnaround stories without proof. And ignore excuses. Instead, focus on stocks with big current earnings growth, strong sales increases, and improving performance quarter by quarter. Because in the stock market, the biggest winners don't whisper. Their earnings announce themselves loud and clear, long before the crowd finally listens. One great quarter can get a stock moving, but long-term winners are built on years of growth. That's the focus of Chapter 4. William O'Neill makes an important distinction here. Current earnings create momentum. Annual earnings create trust. Anyone can get lucky for a quarter, cut costs, sell an asset, benefit from a one-time event. But companies that dominate the market over time show a clear pattern. Their earnings grow year after year, not just once. When O'Neill studied the biggest stock winners in history, most of them had 3 to 5 years of strong annual earnings growth before their major runs. That's not a coincidence. Consistent annual growth tells institutions one thing: this business model works, and institutions don't bet billions on guesses. Think about companies like Apple or Amazon in their early growth phases. Revenue expanded, margins improved, earnings climbed steadily over multiple years. That track record gave big funds confidence to keep buying, even when the stock looked expensive. This is where many retail investors get trapped. They see a company with flat earnings for years, then one good year, and they jump in, thinking the turnaround is real. But the market is skeptical. Without a history of growth, institutions hesitate. And without institutional demand, stocks struggle to sustain major advances. O'Neill's rule here is practical. Look for companies with annual earnings growth of at least 25% over multiple years. Not perfection, but consistency. Another key detail is return on equity. High ROE tells you management knows how to turn capital into profits. It's a signal of efficiency and quality leadership. Strong annual earnings plus strong ROE is a powerful combination. But don't misunderstand this chapter. O'Neill isn't saying to buy old, mature companies just because they've grown before. He's saying to buy growing companies that are still growing. Past growth alone isn't enough. It has to connect with current momentum. So what's the takeaway from Chapter 4? Quarterly earnings tell you what's happening now. Annual earnings tell you who deserves long-term capital. The biggest stock winners sit at the intersection of both. If a company can grow profits year after year, and then suddenly accelerate again, that's when Wall Street pays attention. Because, in the end, The market doesn't reward stories. It rewards proven growth that keeps getting better. Wall Street is obsessed with one thing. What's new? That's the heart of Chapter 5. William O'Neill noticed that almost every big stock winner had something in common. A catalyst, a new product, a new service, a new CEO, or the stock hitting new highs after a proper base. The market doesn't move on what's familiar. It moves on change. Think about the iPhone. Before it launched, Apple was a solid company, but not a monster stock. The moment that product changed consumer behavior, everything changed. Earnings surged, institutions rushed in, and the stock entered a completely new growth phase. That's what NNCAN-SLIM is all about. New doesn't always mean revolutionary technology. Sometimes it's a quieter shift. A company restructures operations. Margins improve. Leadership changes direction. From the outside, it looks boring. But inside the numbers, growth accelerates. Another powerful form of new is price action. O'Neill strongly emphasizes buying stocks, making new highs, not new lows. This goes against human instinct. Most people feel safer buying stocks that are down, thinking they're getting a bargain. But stocks making new highs are telling you something important. Demand is strong enough to push past every seller. There's no overhead resistance, no trapped investors waiting to get out, just buyers in control. This is why O'Neill insists on buying breakouts from proper bases, not chasing random spikes, and not bottom fishing weak stocks. The base shows consolidation. The breakout shows commitment. Now here's where many investors get confused. They hear buy new highs and think that means chasing hype. That's not what this is. O'Neill's approach is structured. The stock must have strong earnings, strong sales, institutional interest, and a well-formed base. Then a breakout to new highs becomes a low-risk entry, not a gamble. So what's the takeaway from Chapter 5? The market rewards companies that are changing the game, not protecting the past. Stop looking for what's cheap. Start looking for what's breaking out for the right reasons. Because in the stock market, new ideas create new demand, and new demand is what drives the biggest winners. At the end of the day, stocks move for one reason: supply and demand. That's it. Chapter 6 strips investing down to its most basic law. When demand overwhelms supply, prices rise. When supply floods the market, prices fall. And William O'Neill shows you exactly how to spot that battle in real time. The clearest signal is volume. Price tells you what is happening. Volume tells you how serious it is. When a stock breaks out of a base on light volume, that move is fragile. It means only small buyers are involved. But when a breakout happens on volume 40%, 50%, even 100% above average, that's institutional demand. Big funds can't sneak in quietly. Their orders leave footprints. Here's a simple real-world scenario. A stock trades sideways for weeks. Supply dries up. Sellers are gone. Then suddenly, earnings hit. Volume explodes. Price pushes higher and holds. That's not retail traders chasing. That's professional money committing capital. O'Neill also points out something most investors miss: tight price action. When a stock stops swinging wildly and starts trading calmly near highs, it tells you supply is being absorbed. Weak hands are gone. Strong hands are in control. On the flip side, heavy volume on down days is a warning. It means institutions are distributing shares, selling into strength before the crowd notices. 1 or 2 days might not matter, but repeated high-volume sell-offs are a message. And the market is very clear when you learn how to listen. This is why O'Neill avoids stocks with huge share counts and massive dilution. Too much supply makes it harder for demand to push prices higher. Scarcity matters. Fewer shares, strong demand. That's a powerful combination. So what's the takeaway from Chapter 6? Stop focusing only on price. Price without volume is incomplete information. Instead, watch how stocks behave at key points. Breakouts on heavy volume, tight action near highs, and minimal selling pressure. Because when demand shows up in size, the market isn't whispering. It's telling you loudly. The stock is under accumulation. And if you can recognize that early, you're no longer guessing. You're following the most powerful force in the market. Big money at work. One of the biggest mistakes investors make is confusing cheap with strong. Chapter 7 draws a hard line between two types of stocks, leaders and laggards. And William O'Neill is very clear. Leaders win, laggards drain your time and money. A leader is the stock setting new highs, outperforming the market, and dominating its industry. A laggard is the stock that looks tempting because it's down, cheap, or due for a bounce. Most beginners chase laggards because they feel safer. If it's already fallen this much, how much lower can it go? That question has destroyed more accounts than bad news ever did. Here's the reality. Weak stocks tend to stay weak. Strong stocks tend to stay strong. When institutions want exposure to an industry, they don't buy the second best company. They buy the number one name. Think about any major trend. In cloud computing, the leaders ran far ahead of the rest. In electric vehicles, one or two stocks captured most of the gains. In AI, capital flowed into the dominant players, not the hopeful challengers. That's not hype. That's how big money operates. O'Neill teaches investors to measure this using relative strength. Relative strength doesn't ask, is this stock going up? It asks, is this stock outperforming everything else? Because outperformers attract more capital, and more capital pushes prices even higher. This creates a feedback loop. Leaders get stronger, laggards get ignored. Another trap investors fall into is emotional attachment. They hold onto a losing stock because they did research, because they believed in the story, because selling feels like admitting failure. The market doesn't care. O'Neill's rule is simple. If a stock isn't acting right, replace it. Capital is a tool. It should always be working for you, not waiting for hope to come true. So what's the takeaway from Chapter 7? Stop trying to be early. Stop trying to be clever. Instead, be aligned with strength. Buy stocks that are leading their industry, making new highs, and outperforming the market. Because in the stock market, the biggest gains don't come from rescuing weak stocks. They come from riding leaders while they're still leading. If you want to know where a stock is going, look at who is buying it. That's the core idea of Chapter 8. Institutional sponsorship matters. Individual investors don't move markets. Big institutions do. Mutual funds, pension funds, insurance companies, hedge funds. These players control the majority of capital in the market. And when they decide to build positions, prices move, often for months or even years. William O'Neill discovered something important when studying big winners. Before most stocks made their biggest runs, they already had some institutional ownership, but not too much. That balance is critical. If a stock has zero institutional interest, there's usually a reason. No confidence, no growth, no catalyst. But if a stock is already owned by everyone, there's no one left to buy. The sweet spot is increasing sponsorship. A few high-quality funds start building positions. Then more follow. Then performance attracts even more capital. That's how trends are born. Here's how this plays out in real life. A growth stock starts posting strong earnings. A few top-tier funds take notice and initiate small positions. As results continue to beat expectations, those funds add shares. Price rises. Charts improve. Other funds feel pressure not to miss out. That's institutional momentum, and it's powerful. O'Neill also emphasizes quality over quantity. You don't want random funds chasing a name. You want experienced managers with a history of outperforming the market. Smart money attracts more smart money. Another key warning in this chapter is about excessive distribution. When you see institutions exiting at the same time, heavy volume selling, failed breakouts, that's a signal that sponsorship is weakening. And once big money leaves, retail investors are left holding the bag. So what's the takeaway from Chapter 8? Don't invest alone. Align yourself with professionals who have real capital at stake. Look for stocks with growing institutional ownership, strong performance attracting new funds, and no signs of mass distribution. Because the most profitable trends don't start with headlines. They start quietly, with institutions building positions while everyone else is still watching. And if you can learn to spot that early, you stop reacting to the market and start moving with the money that actually drives it. You can pick the perfect stock and still lose money. That sounds harsh, but Chapter 9 explains why. Market direction matters more than any individual stock. William O'Neill found that roughly 3 out of 4 stocks follow the overall market. When the market is in a confirmed uptrend, leadership stocks thrive. When the market is in a downtrend, even the best companies struggle. This is where most investors get blindsided. They focus all their energy on finding the next big winner, but completely ignore the environment that stock is trading in. The market is like the tide. You can be the strongest swimmer in the world, but swimming against the tide is exhausting and dangerous. O'Neill teaches investors to read the market using price action and distribution days. A distribution day is when the major indexes fall on higher volume. It's a sign that institutions are selling. One day doesn't mean much, but when distribution starts stacking up, it's a warning that big money is exiting. And when institutions leave the market, you don't argue. You step aside. Another mistake beginners make is reacting emotionally to headlines. Bad news hits. Panic sets in. Good news hits. FOMO kicks in. But O'Neill doesn't care about predictions or opinions. He focuses on confirmation. A market uptrend is confirmed when buying pressure clearly outweighs selling pressure. Breakouts work. Leaders hold gains. Pullbacks are controlled. In a bad market, the opposite happens. Breakouts fail. Leaders break support. Rallies get sold quickly. That's the market telling you to slow down or stop. This chapter also explains why patience is a weapon. There are times when the smartest move is doing nothing, sitting in cash, waiting for conditions to improve. Cash is not a position of weakness. It's a position of discipline. So what's the takeaway from Chapter 9? Don't fight the market. Don't try to outsmart it. And don't confuse activity with progress. Before you buy anything, ask one question. Is the market helping me or fighting me? Because when the market is in your favor, stocks rise faster than you expect. And when it's not, the smartest investors survive by stepping back. So they're ready to strike when the next real opportunity appears. Losses are part of the game, but letting them grow is a choice. Chapter 10 delivers one of the hardest and most important lessons in investing. You must cut losses quickly, without exception. William O'Neill is blunt about this because he's seen the damage firsthand. Most investors don't blow up from one bad trade. They blow up from one small loss that turns into a disaster. Here's how it usually happens. You buy a stock. It drops 5%. You tell yourself it's normal. Then it drops 10%. You start rationalizing. The market is just shaky. It'll come back. At 20% down, you're no longer investing. You're hoping. And hope is not a strategy. O'Neill's rule is simple and non-negotiable. If a stock falls 7 to 8% below your purchase price, you sell. Period. No waiting. No averaging down. No exceptions for great companies. Why? Because the math is brutal. A 10% loss needs an 11% gain just to break even. A 25% loss needs a 33% gain. A 50% loss needs 100%. The deeper the hole, the harder it is to climb out. Professionals understand this, which is why they lose small and live to fight another day. Amateurs do the opposite. They sell winners too early and hold losers too long. That single habit explains most underperformance. Another key insight in this chapter is emotional control. When you refuse to sell, it's usually not about logic. It's about ego. Selling feels like admitting you were wrong. But the market doesn't grade you on being right. It grades you on results. O'Neill also emphasizes that cutting losses frees up capital. Money stuck in a losing position can't be used for better opportunities. And in strong markets, opportunities always come. So what's the takeaway from Chapter 10? Decide your exit before you enter the trade. Treat small losses as tuition, not failure. And remember this, every great investor is wrong often. They just refuse to be wrong for long. Because in the stock market, protecting your capital is more important than chasing gains. If you master this one rule, cut losses quickly and without emotion, you give yourself the single biggest edge most investors never develop. Cutting losses is about survival. But Chapter 11 is about something harder, knowing when to sell your winners. This is where many investors sabotage themselves. They either sell too early because they're afraid of losing gains, or they hold too long because greed takes over. William O'Neill approaches this with one key idea. Great stocks don't peak quietly. Before major tops, there are warning signs. And if you know what to look for, the market gives you time. One of the biggest mistakes investors make is selling just because a stock is up 20 or 30%. Yes, short-term traders might take quick profits, but true market leaders often go much further. O'Neill found that many of the biggest winners climbed 100% to 100%, even 500% or more. If you let them work, the key is not guessing the top. It's watching price and volume behavior. When a stock is acting right, pullbacks are shallow. Volume dries up on declines. The stock respects moving averages. That's strength. But when a stock starts breaking character, sharp drops on heavy volume, multiple failed rallies, or repeated distribution days, that's your signal. Another powerful sell clue is climax action. This is when a stock runs up too far, too fast, often after massive media attention or euphoric headlines. Volume explodes, price gaps up, everyone suddenly agrees the stock is unstoppable. That's usually when professionals start selling into excitement. The crowd buys emotion. Institutions sell strength. O'Neill also warns against falling in love with your winners. A stock is not a trophy. It's not your identity. It's a vehicle for capital growth. The moment it stops acting like a leader, your job is to protect what you've earned. So what's the takeaway from Chapter 11? Don't sell just because you're uncomfortable with gains. And don't ignore clear warning signs just because you like the company. Instead, let winners run while they act right. Watch for heavy volume selling and character change. And sell decisively when the trend breaks. Because making money in stocks isn't just about buying well. It's about selling well. And the investors who build real wealth are the ones who know how to exit winners. Without fear, without greed, and without letting profits slip away. You don't go broke from one bad stock. You go broke from bad money management. That's the focus of Chapter 12. William O'Neill makes this point very clear. Even the best stock picks won't save you if your position sizing and risk control are wrong. Most investors obsess over what to buy. Professionals obsess over how much to buy. That difference changes everything. O'Neill warns against over-diversification. Owning 20 or 30 random stocks doesn't reduce risk. It usually increases confusion. When you spread yourself too thin, winners can't move the needle, and losers quietly drain your account. At the same time, going all in on one idea is just gambling. Smart investors concentrate selectively. They put meaningful capital into their best ideas, the stocks that meet all criteria, while keeping risk tightly controlled. Another major topic in this chapter is leverage. Margin can amplify gains, but it also magnifies mistakes. O'Neill is cautious here. If you don't already have discipline, experience, and a proven system, margin will expose every weakness you have. The same goes for options, short selling, and exotic strategies. These tools are not shortcuts to success. They are force multipliers, and they multiply both skill and error. O'Neill also addresses long-term investing versus active management. He doesn't argue that one approach fits everyone. Instead, he emphasizes self-awareness. If you don't have time to monitor markets, you shouldn't pretend you're a full-time trader. But if you do manage actively, you must respect rules, manage exposure, and protect capital. One of the most underrated ideas in this chapter is flexibility. Markets change. Conditions shift. What worked last year may not work now. Good money management adapts. So what's the takeaway from Chapter 12? Your goal is not to be fully invested at all times. Your goal is to be correctly invested. That means position sizes that won't destroy you, enough focus to benefit from winners, and enough discipline to survive losing streaks. Because in the stock market, how you manage money determines whether you stay in the game. And staying in the game long enough is what allows skill, discipline, and opportunity to finally compound into real wealth. Most investors don't lose money because the market is rigged. They lose money because they keep making the same mistakes over and over again. Chapter 13 is uncomfortable because it holds up a mirror. William O'Neill lays out the most common errors that destroy performance. And what's shocking is how ordinary they are. These aren't rare mistakes. They're habits. One of the biggest is buying stocks after they have already run too far. A stock goes vertical. Social media lights up. Everyone suddenly agrees it's a great idea. That's usually when risk is highest, not lowest. O'Neill reminds us that the best entries happen before excitement, during proper bases, not emotional spikes. Another costly mistake is averaging down. Buying more just because a stock is cheaper feels logical. But cheaper doesn't mean better. If the stock is falling, the market is telling you something. Ignoring that message doesn't make you disciplined. It makes you stubborn. Then there's the obsession with low P/E ratios and value. O'Neill found that many of the biggest winners looked expensive before they made their biggest moves. Focusing only on valuation causes investors to miss growth, and growth is what drives stock prices. Another silent killer is lack of a selling plan. Many investors know exactly why they bought a stock, but have no idea when they'll sell it. So when price starts falling, emotions take over. Fear, hope, regret, none of which belong in investing. O'Neill also warns against listening to too many opinions. Friends, TV analysts, online forums. When everyone has a different idea, conviction disappears. Great investors simplify. They trust their rules more than outside noise. And finally, there's the biggest mistake of all, failing to learn from losses. Every loss contains information about timing, about discipline, about decision-making. Ignoring that lesson guarantees repetition. So what's the takeaway from Chapter 13? You don't need more indicators. You don't need better predictions. You need fewer mistakes. Avoiding errors won't make headlines, but it will protect your capital and sharpen your edge. Because in the stock market, success isn't about doing extraordinary things. It's about not doing the ordinary things that cause most people to fail. And once you eliminate those habits, your results don't just improve. They finally start to compound. If you want to get better at investing, don't study theories, study winners. That's the entire purpose of Chapter 14. William O'Neill believed that the market leaves clues, and the best place to find them is in past stock market champions. When he analyzed history, he wasn't looking for opinions. He was looking for patterns, and what he found was powerful. The greatest winners, across decades, shared remarkably similar characteristics. Different industries, different eras, same behavior. Most of these stocks had strong earnings growth before their big moves. They built proper bases. They broke out on heavy volume. And they stayed strong while the market was healthy. This is not coincidence. It's structure. Think of studying great stocks like studying elite athletes. You don't learn how to sprint by reading philosophy. You watch runners with perfect form, and you train your eye to recognize what excellence looks like. O'Neill encourages investors to do the same with charts. Study the winners before they exploded. Study how they acted during their advances. Study how they topped. Over time, your brain starts to recognize strength instantly. Another key idea in this chapter is repetition. Markets change, but human behavior doesn't. Fear, greed, hesitation, euphoria. These emotions shape price action, and they repeat in every cycle. That's why a winning pattern from 30 years ago can still teach you something today. Many investors skip this step. They want shortcuts. They want alerts. They want someone else to tell them what to buy. O'Neill pushes back hard on that mindset. He wants you to become self-sufficient. When you know what winning stocks look like, you don't need constant validation. You can act with confidence and patience. So what's the takeaway from Chapter 14? The market already showed you how to win. The evidence is there, in black and white, on the charts of past leaders. Your job is to study them, internalize the patterns, and apply those lessons when new opportunities appear. Because in the stock market, experience doesn't come from time. It comes from pattern recognition. And the faster you train that skill, the faster you stop guessing and start investing with clarity and conviction. Great stocks don't rise alone. They rise as part of a bigger trend. That's the core lesson of Chapter 15. William O'Neill found that most major stock winners came from a small number of leading industries. When money flows into the market, it doesn't spread evenly. It concentrates. And investors who ignore that reality end up swimming against the current. Think about how capital moves when a new theme starts working. Technology, healthcare, energy, AI. Funds don't buy just one stock. They build exposure across the entire group. The strongest names rise first. Then the second tier follows. And finally, latecomers chase what's already extended. O'Neill teaches investors to focus on the front of the wave, not the back. If a stock looks great, but its industry is weak, it's fighting gravity. But when a stock is breaking out and its sector is attracting money, you have alignment. That alignment dramatically increases your odds. One practical tool here is industry relative strength. Ask simple questions. Which sectors are outperforming the market? Which groups have multiple stocks hitting new highs? Where is capital clearly flowing? Those answers matter more than stories. O'Neill also warns against falling in love with isolated ideas. A single stock can't carry a weak group forever. Eventually, institutional investors rotate to where momentum is strongest. That's why many breakouts fail. Not because the company is bad, but because the theme is wrong. Another key insight is timing. Industry leadership changes over time. What worked last year may stall this year. Staying flexible is essential. You don't argue with rotation. You follow it. So what's the takeaway from Chapter 15? Stop hunting for random winners. Start tracking where money is clustering. Focus on stocks that are leading their industry, part of a strong market theme, and breaking out while peers are also moving. Because in the stock market, the biggest gains come when individual strength lines up with sector momentum. When you combine a great stock with a great group, you're no longer guessing. You're positioning yourself exactly where institutional money wants to be. Great investors don't search randomly. They use systems. Chapter 16 explains how William O'Neill uses tools like Investor's Business Daily, not to predict the market, but to filter opportunities. This is an important distinction. Tools don't make money. Decisions do. Most investors open a stock screener and get overwhelmed. Hundreds of names, too many signals, no clarity. O'Neill's approach is the opposite. He starts with strict criteria: strong earnings growth, strong sales, high relative strength, institutional sponsorship, and proper chart patterns. Anything that doesn't meet those standards is ignored immediately. This is how professionals save time and energy. Instead of asking, "Which stock should I buy?" they ask, "Which stocks even deserve my attention?" IBD-style tools are designed to answer that question. They narrow the universe from thousands of stocks to a short, manageable watch list. From there, price action and market conditions decide the rest. Another key lesson in this chapter is preparation. O'Neill doesn't wait for breakouts and then scramble. He prepares in advance. He builds watch lists. He studies bases. He knows exactly where a stock should be bought and where it's wrong. When the market gives the signal, execution is calm and decisive. No panic, no chasing, no hesitation. This chapter also highlights discipline. Just because a stock appears on a list doesn't mean it's a buy. It's a candidate. Only when market direction, volume, and price action align does it become actionable. Many investors misuse tools by treating them like shortcuts. They blindly buy top-ranked stocks without understanding why they rank highly. O'Neill warns against that. Tools should sharpen your thinking, not replace it. So what's the takeaway from Chapter 16? Stop scanning endlessly. Stop reacting emotionally. Build a repeatable process. Use tools to filter for quality. Create focused watch lists. Prepare before the move happens. Because in the stock market, success favors investors who are ready before opportunity arrives. And when preparation meets the right market conditions, execution becomes simple and results become consistent. The news doesn't move stocks. The market's reaction to the news does. That's the core lesson of Chapter 17. Most investors think staying informed means reacting quickly to headlines, earnings reports, economic data, breaking news alerts. But William O'Neill teaches the opposite approach. Watch the price first, because by the time news reaches the public, institutions have already acted. Here's a common scenario. A company reports record earnings. The headline looks perfect. Analysts praise the results, but the stock gaps up and then sells off hard. That's not bad luck. That's distribution. It means expectations were already high. and big investors are using the excitement to exit positions. Now flip the situation. Bad news hits. The stock drops briefly, then quickly recovers and pushes higher. That's strength. It tells you the market has already discounted the news, and demand is still there. O'Neill's point is simple. Price action reveals true expectations. News only tells you the story. Price tells you the truth. This is why reacting emotionally to headlines is so dangerous. Fear makes you sell at the bottom. Excitement makes you buy near the top. Professionals stay detached. They ask, did volume confirm the move? Did the stock hold key levels? Did behavior change or stay intact? Another important idea in this chapter is selective attention. You don't need to track every news event. You need to track market-changing events, interest rate shifts, major earnings trends, broad economic signals. Even then, you don't predict outcomes. You observe reactions. O'Neill also warns against overtrading during volatile news cycles. Fast markets punish impulsive decisions. Spreads widen. Emotions spike. Sometimes the smartest move is to step back and let volatility settle. So what's the takeaway from Chapter 17? Stop trading headlines. Stop reacting to noise. Instead, let price and volume lead. Judge news by market reaction. And stay emotionally neutral. Because in the stock market, being informed is not about knowing more news. It's about knowing which signals actually matter. And when you learn to trust price action over opinions, you stop getting whipsawed by headlines and start moving in sync with how the market truly thinks. You don't need to trade every day to build real wealth. That's the message behind Chapter 18. William O'Neill makes a point that surprises many people. Some investors can become millionaires without ever picking individual stocks. Mutual funds, when chosen correctly, can do the heavy lifting. Here's why. Great mutual funds are managed by professionals with deep research teams, strict risk controls, and access to information individual investors don't have. When these managers find winning stocks, they accumulate positions patiently over time. And if you stay invested in the right funds during the right market phases, compounding does the rest. But O'Neill is careful here. Not all funds are created equal. Most mutual funds underperform the market. High fees, poor timing, and lack of discipline slowly eat away returns. That's why selection matters. O'Neill emphasizes growth-oriented funds with a history of outperforming the market, managers who invest heavily in leading stocks, and clear, consistent strategies. These funds tend to shine during strong market cycles because they're aligned with leadership. Another key idea in this chapter is time in the market. For investors with full-time jobs or limited experience, trying to actively trade can be a disadvantage. Emotions creep in. Decisions get rushed. Mistakes compound. A disciplined investment into top-performing growth funds, especially during confirmed market uptrends, can outperform most individual investors over the long run. O'Neill also highlights dollar-cost averaging. Investing consistently over time reduces emotional decision-making and smooths out market volatility. You're not trying to time every top and bottom. You're participating in long-term growth. That said, O'Neill doesn't present mutual funds as a passive excuse. Even fund investors must pay attention to market direction. During major downtrends, capital preservation still matters. So what's the takeaway from Chapter 18? You don't need complexity to succeed. You need discipline and alignment. Whether you invest through individual stocks or mutual funds, the rules don't change. Follow the market trend, focus on leadership, and avoid emotional decisions. Because wealth isn't built by activity. It's built by consistency, patience, and staying aligned with growth over long periods of time. To really understand the stock market, you have to understand how institutions think. Chapter 19 pulls back the curtain on pension funds, endowments, and large institutional portfolios, the players that quietly shape long-term market trends. These institutions don't trade like individuals. They manage massive pools of capital, with strict rules, committees, and performance benchmarks. And that reality explains a lot about how markets behave. First, institutions can't move fast. When a pension fund wants to buy a stock, it can't just hit buy and move on. It has to accumulate shares over weeks or months, without pushing the price to high. That slow, steady buying is what creates sustained uptrends. This is why O'Neill emphasizes patience. When institutional demand is building, the move isn't explosive at first. It's controlled, orderly, almost boring. But over time, that consistent demand compounds, and the stock trends higher for much longer than most people expect. Another key insight from this chapter is risk control. Institutions are obsessed with downside protection. They diversify across sectors. They reduce exposure when markets weaken. They follow allocation rules, not because they lack conviction, but because survival matters more than short-term performance. That mindset is something individual investors rarely adopt. Many retail traders swing for home runs. Institutions focus on avoiding catastrophic losses, and that discipline is why they stay in the game decade after decade. O'Neill also points out that institutions rotate capital constantly. Money flows from one asset class to another, from stocks to bonds, from growth to defense, from one sector to the next. These shifts don't happen randomly. They respond to economic cycles, interest rates, and market health. Investors who understand this stop taking moves personally. When a stock stalls, it's not always about bad fundamentals. Sometimes capital is simply rotating elsewhere. So what's the takeaway from Chapter 19? Think bigger. Stop viewing the market as a series of isolated trades. Start seeing it as a capital allocation system. If you align yourself with how institutions manage risk, timing, and exposure, your decisions become calmer and more strategic, because the investors who last aren't the ones chasing excitement. They're the ones who understand how big money moves and position themselves patiently and intelligently. Right alongside it, after everything you've learned, Chapter 20 brings it all home. Not with a new strategy, not with a secret trick, but with rules. William O'Neill understood something most investors never accept. Success in the stock market is not about intelligence. It's about discipline. You can know everything about earnings, charts, and market cycles, and still fail if you don't follow rules consistently. That's why this final chapter is about reminders. Because under pressure, people forget. They forget to wait for proper setups. They forget to cut losses. They forget that the market doesn't care about their opinions. O'Neill stresses the importance of having written rules. Not rules you keep in your head. Rules you can't negotiate with. Rules that tell you when to buy, when to sell, when to stay in cash. Because when emotions kick in, logic disappears. Fear makes losses feel unbearable. Greed makes gains feel permanent. And both destroy discipline. Another key theme here is humility. The market is bigger than you, stronger than you, and always in charge. The moment you think you've mastered it, it will remind you otherwise. That's why O'Neill encourages investors to stay flexible. If the market changes, you change. If leadership shifts, you adapt. If conditions worsen, you protect capital. No ego, no stubbornness, just response. This chapter also reinforces a powerful truth. You don't need to catch every move. You don't need to trade every day. You don't need to be right all the time. You just need to be right enough and disciplined enough over time. Most fortunes aren't built in one trade. They're built through a long series of correct decisions, made consistently, with risk always under control. So what's the final takeaway from this book? Follow a system, respect the market, protect your capital, because when you do those three things, profits take care of themselves. And that's the real lesson of how to make money in stocks. Not how to beat the market once, but how to stay in the game long enough, with enough discipline, to let growth, time, and compound returns work in your favor. If you found this breakdown useful, make sure to hit the like button. It really helps this channel reach more people who want to invest smarter. Subscribe if you want clear, no hype lessons on how real investors think, buy, and manage risk in the stock market. Drop a comment below and tell me which chapter hit you the hardest. And if you want the next deep dive, practical, disciplined, and based on proven systems, turn on notifications because the next video might change how you invest forever.